Very good morning, dear students. Till yesterday, we have completed with company final accounts, right? How to prepare the company final accounts, which includes the financial statements of the company, starts from the calculation of cost of goods sold till the preparation of balance sheet. Today, let us move to the another unit with the new topic called underwriting of shares. What is this underwriting of shares? What is meant by underwriting? You all know what is shares, right? Shares means it is a kind of a certificate issued by a company for the purpose of subscribing a company shares, right? So here, what is underwriting? What happens here at the time of formation of the company when they go for acquiring the capital from various sources? So at the time of acquiring the sources, the company choose an option of issuing of shares. That shares will be issued to the public by the company. The shares of the company issued to the public may be subscribed or may not be subscribed by the public. What happen if in case it is not subscribed? As per Security Exchange Board of India, they says that at least 90% of the subscription must be made. It may be anybody, it can be either individual or institution or any person, but there must be at least 90% of the subscription in order to form a company. Okay, so for this purpose, in case if they also say, in case if the 90% of the shares are not subscribed, then the amount whatever received from the public must have to be returned back. It leads to non-formation, right? The company cannot able to make a formation, make establishment of the company. In this way, what the underwriters will do, they are the one who undertake the risk of the company. Underwriters who are going to take the risk of subscription of shares of the company, irrespective of the shares subscribed by the public. Irrespective of the shares subscribed by the public, the underwriters are going to undertake the risk of subscribing the shares of the company. So they are called as underwriters. Underwriting here, in the sense, it is just an agreement between underwriters and a company. Underwriting is an agreement between underwriter and the company, where the underwriters agree where the underwriters agree to take up either whole, that means either the underwriter may agree to take up whole portion of complete shares issued by the company, or only the small portion or portion of part of the shares of the company issued by the public, issued to the public by the company. It is called as underwriting. Underwriting, in the sense, it is underwriting is nothing but it is an agreement. Agreement between whom? Agreement between underwriters and a company, for which the underwriters are going to underwrite or subscribe the shares of the company either fully or partially. This is called as underwriting. There are actually the underwriters who are going to subscribe these shares for some consideration called as underwriting commission. So they will not undertake any subscription, right? Whatever we are going to do, we are working here as an employee. In turn of what? In turn of in return we expect salary. Here the shareholders invest capital into the business by expecting dividend. The financial institution lend loan to the needy people by expecting the interest on which. So in the same way here, the underwriters also underwrite or undertake the risk of subscribing the shares of the company, mainly for the purpose of earning commission, so called as underwriting commission. So as per the Company Act of 2013, for every subscription made by the underwriters, for them the commission must be payable at the rate of 5% on the face value. Suppose 1 unit of shares are issued at the rate of 10 rupees, means on 10 rupees 5%, on 10 rupees 5% means 50 paise will be given as a commission for 1 unit of shares. 1 unit of shares. In case they are underwriting the debentures, then 2.5%, minimum of 2.5% must have to be paid, not less than that. More than that may the company give, but not less than that percentage fixed according to the Company Act of 2013. And let us understand the terminology, very important concepts here. One is marked applications. What is meant by marked application here? The marked application in the sense, suppose when there are more than one underwriters, it is necessary for the company to know that which application is received from which underwriters. Suppose there are four underwriters, maybe one, two, three, and four underwriters. So the company has issued 10,000 shares at the rate of 10 rupees. That 10,000 shares applications are received from the public, and this are fully underwritten by the underwriters, by more than one underwriters. So even though it is received from the public, since the underwriters have taken a risk to subscribe the shares, and in turn they are issued to the public, so this applications received, in case if there is applications bearing an official stamp of any underwriters, that is called as marked application. That so that which helps for the company to know which application, the application is having a seal in that, which mentioned on, I mean, which is sealed on the applications received from the public, which helps the company to know that which application is of which underwriters. Okay, so this is called as marked application, means the application which is having an official stamp of an underwriter is called as marked application. Unmarked means there will be no official stamp of underwriters, means it is understood that the application directly received from the public, not through any underwriters. Got it? Application directly received from the public, not through any underwriters, that is called as unmarked application. What are all we discussed just now? What are all we discussed? We have discussed about underwriting of shares, who are called as underwriters, what is underwriting, what is called as underwriting commission, and what is nothing but marked application and unmarked application. Let us now understand what are the different types of underwriting. Mainly, this types of underwriting is classified into four categories. One is complete underwriting or full underwriting, we can say. And the second one is partial underwriting. Third is firm underwriting. And finally, pure underwriting. So the concepts which we have discussed here is underwriters, then underwriting, then underwriting commission we have discussed. It can be either 5% if it is a shares, and 2.5% if it is a debenture. Then we have discussed what is marked application. Marked application which have an official stamp of underwriters. Unmarked means unmarked applications which do not have official stamp of underwriters, called as unmarked application. Let us now understand the types of underwriting. So this types of underwriting which includes full or complete underwriting, then partial underwriting, firm underwriting, then pure underwriting. Look at here. What is meant by full or complete underwriting? The name itself says that the underwriters are subscribing complete shares or debentures of the company, called as full underwriting. So, irrespective of the shares subscribed by the public or not, completely the shares or debentures of the company are underwritten by the underwriters, called as complete underwriting, or also called as full underwriting. Then what is partial underwriting here? Partial underwriting, in a sense, suppose the company has issued 20,000 shares to the 20,000 shares of shares to the public, in which the shares are part of the shares are subscribed by the underwriters. Maybe one or more underwriters are subscribing part of the shares of the company. That is called as partial underwriting. They are not underwriting complete shares of the company. Instead, they are going for underwriting only partial shares of the company, called as partial underwriting. In such case, what happened at the time of calculation of liability of the underwriters? Out of the 20,000 shares issued by the company, only 9,000 shares are subscribed by the underwriter, called as partial underwriting. Only 9,000 shares are subscribed by the public. I'm sorry, by the underwriter. And remaining 11,000 shares are not subscribed by the underwriter, whereas it is directly subscribed by the public. Maybe directly subscribed by the public. So in that situation, what happened at the time of calculation of liability? That liability will be taken in the name of, which will be deemed to be considered in the name of company itself. For the remaining 11,000, it will be considered in the name of company itself, the liability, because underwriters has taken only 9,000 shares for underwriting, whereas remaining 11,000 is a liability of the company to issue to the public and to get subscription from the public. Okay, next is firm underwriting. What is this firm underwriting means? Firm underwriting here, in the sense, it is an arrangement in which where company as well as the underwriters, where in which the underwriters make a definite commitment here, where the underwriters make a definite commitment to take up the certain shares or debentures of the company. What happens? The company, as I said, 20,000 shares are issued by the company, where they say that the underwriters say that 15,000, whether it is public subscribed by the public or not, I'm going to, or one or more underwriters are going to subscribe 15,000 shares of the company, irrespective of whether it is subscribed by the public or not. That is called as firm underwriting. In the sense, there is a definite commitment where the underwriters are committing for that particular shares or debentures that they are going to undertake, whether it is subscribed by the public or not. What happened? This 15,000, say for example, 15,000 shares are subscribed by the public, right? This 15,000 15,000 shares, or 20,000 shares are issued by the company. Out of 20,000 shares, 15,000 shares are subscribed by the underwriters. They have taken an underwriting to subscribe that 15,000 shares. Okay, it can be also called as partial underwriting, where this 15,000 shares, what they are making a definite commitment, in case if they able to make a subscription from the public in that 15,000, that will be benefited for the underwriters. If not, also if they are failed to make a subscription to the public by issuing this 15,000 shares to the public, then the underwriter themselves will be the they will be having the liability to, they are the responsible person to underwrite or to make the payment of that particular shares or issue subscribed as a definite commitment to the company, called as firm underwriting. Next is pure underwriting. Pure underwriting, in the sense, here what they say, they are not making any definite commitment. The underwriters are not making any definite commitment here. They say that in case if the shares are not subscribed by the public, shares are not subscribed by the public, then they are going to subscribe that particular shares called as pure underwriting. Are you getting my point? So here, in case if the shares are not subscribed by the public, then the underwriters are agree. Underwriters are ready to take that remaining portion of the shares which is not subscribed by the public. That is called pure underwriting. Whereas under firm underwriting, in the beginning itself, they make a definite commitment. They make a definite commitment to subscribe the shares of a company. Okay. This is about an important concepts which we are discussed. Then let us now discuss the liability of the underwriters. To discuss the liability of the underwriters, we have a format for calculation of liability and various methods also. Mainly the methods are classified like when the shares are fully underwritten by the underwriters, when the shares are fully underwritten without firm underwriting and with firm underwriting, then when the shares are partially underwritten by the underwriters with underwriting or without underwriting, and then also when there is a firm underwriting, in case if this firm underwriting is treated as marked application, what will be the liability? And then firm underwriting, if it is considered as an unmarked application, what may be the liability to the underwriters? These are the various methods we have. Let us discuss with problem. Okay, before going for the problem, I'll just give you the format for the calculation of the liability of underwriters. Liability of the underwriters. You can see that calculation of net liability of the underwriters. Calculation of net liability of the underwriters. Suppose if there is only one underwriter and if he is being fully underwritten, then the liability of only one underwriter will be taken. Okay, and if there is only one underwriter but only partial underwriting is underwriting has been taken by the underwriter, then suppose A is an underwriter and he has taken only partial subscription. In that situation, and the remaining liability will be taken in the name of company. Okay, when there is only one underwriter. Even if there are more than one underwriter also, suppose there are two underwriters and these two underwriters are underwritten only partial or the portion of the shares of the company, then the remaining portion will be the liability of the company to subscribe it. Okay, like this the calculation will be made. In case if suppose completely underwritten by the underwriters, if the underwriters are completely underwriting the shares of the company, shares or debentures of the company, then it will be distributed to the liability will be divided among the underwriters and it will be distributed among them. Okay, when there are more than one underwriters and fully underwritten. Okay. So this is a format where when there are calculation of net liability of the underwriters, when there are more than one underwriters with full underwriting and no and without firm underwriting. Without firm underwriting. Okay, this is without firm underwriting. There is no firm underwriting, but there are more than one underwriters, and they have underwritten full underwriting. Okay. Now, first one is gross liability. Gross liability. So, what next they have to do? What is a gross liability? What gross liability, in the sense the total application received by the company may be the gross liability. This gross liability will be okay. Suppose this will be taken as a gross liability, and from this first we have to deduct marked applications. Marked applications. Deduct marked application. If you deduct marked application, the balance what we get from that, we need to again deduct unmarked applications. Unmarked applications. Whatever the balance left must be deducted with unmarked application. Balance what we get is called as what? Net liability. Net liability. What is called marked application and unmarked application? You know this, right? What is marked application and unmarked application? Marked application. What is marked application? Marked application means it is the liability, where the application received from the public will be having an official stamp of the underwriters called as marked application. Whereas if it doesn't have any seal or official stamp of the underwriters, then that is called as unmarked application. And this marked application will be having a mark, that is official stamp of individual underwriters, where the company can easily find out whose liability, which application is belong to which underwriters. But in case of unmarked application, there will be no official stamp. But in this situation, completely all the shares are subscribed by the underwriters. Completely it is a full underwriting. All the shares are subscribed by the underwriters, but still some of the shares are not marked. Some of the shares are not marked, which cannot be taken as a company liability. The unmarked application cannot be taken in the name of company. Why? Because here all the shares are completely subscribed. It is not that unofficial. Just an application received will not be having any official stamp. That's it. Okay. So when there is a marked with the stamp of the particular underwriter, that is marked application. If not, that is unmarked application. It doesn't mean that it is an non-official, unofficial. Okay. Next, this there is no stamp like official stamp and unofficial stamp. Okay, only if it is marked with a stamp or seal of the underwriter saying this application is from A, this application is from B, like that, then that is called as marked application. If not marked, that is unmarked application. That's it. Okay. And this unmarked application must have to be distributed or divided among the underwriters. On what basis it will be divided? This unmarked applications are divided if nothing is stated in the problem. If it is stated in the problem, we can take according to that ratio. If not stated anything in the problem, we can the unmarked applications can be divided among the underwriters. Divided among the underwriters on gross liability ratio. On gross liability ratio. Okay, now we'll do one problem based on this. Okay, this is a problem. Look at this problem. Mantesh company issued 45,000 equity shares of rupees 100 each. The issue was fully underwritten by A, B, and C equally. Applications were received for 39,000 shares, out of which marked applications were as follows. Marked applications of A is 15,000, B is 10,000, and C is 5,000. Determine the liability of A, B, and C, and also pass the journal entries assuming 5% rate of commission. Okay, this is the problem they have given. Here they're saying the company has issued, Mantesh company has issued 45,000 equity shares, total of 45,000 equity shares at the rate of 10 rupees they have issued. This is the face value, 100 rupees is the face value, and they are issuing equity shares. How many shares they are issuing? 45,000 shares. Out of this 45,000, they said it is fully underwritten by A underwriter, B underwriter, and C underwriters. A, B, and C underwriters equally. A, B, and C underwriters equally. Applications received from the public for 39,000 shares. How many applications received? So they are totally issued 45,000 shares, and it is subscribed completely by the underwriters equally, three underwriters equally. Whereas from the public, they are received only 39,000 shares, out of which marked applications were as follows. So out of 39,000 shares, the marked applications are: A is 15,000, from B is 10,000, and C is 5,000. Determine the liability of A, B, and C. So first we have to calculate the liability of underwriter A, underwriter B, and underwriter C, and then we need to pass the journal entries based on that at the rate of 5% commission. Let's We'll solve this problem. Okay. First, we'll write this as what we are going to calculate: liability, right? Calculation of net liability, or yes, net liability of A, B, and C underwriters. A, B, and C underwriters. Okay, first one is particulars. Okay, I'll copy the same as it is there here. Particulars. Particulars: A underwriter, B underwriter, and C underwriter. Next is total. Okay, first we need to take what? Gross liability. Okay, what is considered as gross liability here? Look at the shares of the company is 45,000, whereas they are subscribed completely, and it is distributed among the shareholder underwriters equally. They are subscribing 45,000 shares equally among them. Okay, so this this is considered as a gross liability. Equally means this 45,000 shares are distributed in 1 is to 1 is to 1 ratio. Correct, equally. Okay, 1 is to 1 is to 1 is, in the sense, total shares are 45,000. Out of 45,000, 45,000 divided, I mean, into 1 divided by 3 means it is 15,000. Equally 15,000. 45,000 divided by 3, it will be equally distributed among the shareholder, underwriters. Next is, what we have to do? We have to deduct marked application. Marked application is specified here in the problem for A 15,000, A 15,000, B 10,000, and C it is 5,000. What's the total of marked application? Total marked application is 15, 10 plus 5. 30,000. It is 30,000. Take the difference. Deduct marked application from gross liability. Then the balance of A is 0. Balance, that means completely applications, how much ever the application subscribed by the underwriter A has completely received from them. Then from B only 10,000 application received, whereas they have underwritten 15,000 shares. So remaining there is a liability of 5,000. Then for C there is a liability of 10,000. So totally 15,000 shares are left. Now we have to deduct what? Unmarked application. Unmarked applications. How to calculate unmarked applications? The company has issued 45,000 shares, whereas how much the applications received? Applications received were 39,000. Applications received were 39,000. So we can calculate unmarked applications by using this formula. It is equal to total applications received, total applications received minus marked application. Minus marked application. What's the total application received? Total application received, it is 39,000. 39,000 minus marked application. Look at here. This is the marked application. Marked application is 30,000. Take a difference of it. 9,000 is unmarked application. And this 9,000 is unmarked application. Okay. And this 9,000 of unmarked application can be, we'll take this. This is working note number 1. Okay, about calculation of unmarked application. Next, that's number 1. And second one, we'll write a note on this that unmarked application can be divided among the underwriters on gross liability ratio. So now let us divide this 9,000 in the ratio of 1:1:1. Okay. Now, if you divide that 1:1:1 in the sense that 9,000 must be divided in 3 portions. Divide that 9,000 in 3 portions. 9,000 divided by 3 means it is 3,000. That 3,000 will be distributed to the shareholder, underwriters. 3,000, 3,000, and 3,000. Balance is 3,000 minus balance we got, right? 0 minus 3,000 means it is minus 3,000, then plus 2,000 and 7,000. So difference is 6,000. What we have to do now? Balance, that is we can say surplus of A can be distributed to B and C underwriters in the ratio of 1:1. What we are doing here, look at here, there is a minus balance of 3000. There cannot be excess of subscription, right? Total application received is only 45000, but out of 45000 they are they are out of 45000, they have received 39000 applications. Out of 39000 application, there is a 9000 application yet to be received, but it is not yet received. So hence this 9000 shares which are been distributed or divided among all the underwriters equally, irrespective of the shares or marked applications received from them, equally it has to be distributed. But whereas we got this unmarked application minus, I mean, sorry, the liability of A is minus balance, and this A minus balance of 3000 is not the liability of an underwriters. So this must be distributed or divided among B and C, distributed among B and C in the ratio of gross liability. B and C ratio is 1 is to 1, so that must be distributed in that ratio. This 3000, this 3000 now distributed among 3000 is distributed among B and C. Okay, so 3000 divide this between B and C equally, means 1 is to 1 ratio. 3000 divided by 2 means 1 plus 1 is 2, divided between two underwriter is 1500 and 1500. So this is a simple calculation, that is the ratio, how to calculate the ratio and how to calculate the portion of particular amount based on the ratio is a simple one. You can do it among yourself, need not to explain that simple calculation logic, right? Okay, next, total is minus plus 3000, and we are deducting this 1500. Look at here what we are doing, we are deducting this. So minus and minus is plus for this, in the sense we are adding this 3000 here, whereas deducting the same 1500 total of 3000 among B and C underwriters. Now take the difference, 0 liability for A, and the difference of 500 liability of B, and 6000, sorry, 5500 liability of C. Total is 6000. This is called as net liability. Whenever there is a surplus arises, you must have to be distributed like this among the other underwriters in the ratio of gross liability. Got my point? Everyone understood the calculation of the net liability? It is a simple calculation one and a simple format also. Everyone got it? Now, they also asked us, look at the problem. Determine the liability of A, B, and C, and also pass the journal entry. We have to pass the journal entry. What is the format? What are the entries which come across here for the underwriters? We'll do that now. Journal entries. Okay, journal entries. This journal entries we are passing in the books of which company it is? Mantage company, right? Journal entries in the books of Mantage company. Mantage company. Okay, let us take the format. Format is first column can be serial number, particulars, then amount in rupees, amount column, amount to amount column. Serial number, plus, then debit, it is in rupees. This is credit balance in rupees. We'll do this one by one. First entry. What we have to pass for the first entry, whatever the applications received from the public, for that the company is receiving the amount of cash, or it may be deposited to the bank. Okay, so not, most probably not in terms of cash, so bank account, right? So that amount of capital whatever subscribed by the public and it is being received from the public can be transferred to the equity share capital account. Now tell me how many shares are received from the public. That is 39,000 shares. 39,000 shares. This 39,000 shares at the rate of face value of 100 rupees. Correct? So 39,000 shares are received from the public at the rate of 15,000. In the sense, the first entry will be bank account, bank account, okay, bank account debtor to equity share capital account. Equity share capital account means how many shares are received from the public. 39,000 shares. This 39,000 shares at the rate of rupees 100 each. How much amount? 39,000 into 100 means 3 lakh, sorry, 39 lakh, correct? Yes, 39 lakhs. Okay, the same amount is being transferred to the equity share capital account. We can give a narration for this. What narration we can give? Being application, being applications money received from the public is transferred to equity share capital account. Okay, next, second entry. What is the second entry? For second entry, see, the company has issued total of how much? Company has issued total of 45,000 shares. Look at here, they have issued 45,000 shares, but out of 45,000 shares, how many shares are received from the public? Only 39,000 shares. What is the remaining left out? 6,000, right? 6,000 shares. These 6,000 shares are the liability of which underwriter? It is only, see, this 6,000 of shares is the liability of B and C, not A, because A has from A, I mean from the public, applications received from the public has completely marked with 15,000 of shares of the shares underwritten by A as completely received from the public, marked with A underwriter, right? So there is no liability of A underwriter again, but we need to receive amount from the underwriter B and C, because still they are liable to, there is a liability of underwritten by B and C. Okay, so B underwriter is 500 shares have to subscribe, in the sense that is the liability for them to make the payment of with regard to that particular share, and even C also 5,500 shares amount of capital must be paid to the company. Okay, total of 6,000. Let us pass entry for that. Whose liability it is? Liability of underwriters. So B and C underwriters. B's account, B's account debtor, then C's account debtor, to where it should be transferred? It should be transferred to same equity share capital account, so that the equity share capital amount must be 45 lakhs. Already 39 lakhs of capital is credited to equity share capital account. Remaining, how much it should be credited? Remaining 6 lakh rupees of capital must be credited to equity share capital account. Okay, this 6 lakh equity share capital amount is the liability of B and C underwriter to subscribe. So here B underwriter has to subscribe 500 shares of rupees 100 each, whereas C underwriter has to subscribe 5,500 shares of rupees 100 each. What is the amount? It is 50,000 for B and 5,50,000 for 5,50,000 for A. Okay, 50,000 of B and 5,50,000 of C. So total is 6 lakh rupees of capital must be subscribed and paid by the underwriter B and C. We can write this narration as being underwriters B and C the underwriter B and C is liable to subscribe the unsubscribed shares. Okay, so this is the narration. Third one, the third entry is now 45 lakh rupees of capital is credited to equity share capital account. Means we know that completely 45,000 shares are subscribed. 39 lakh by the public and remaining 6 lakh by the underwriters. Now next thing is we have to calculate the commission of the underwriters. How much commission is to be paid to whom? So look at here, commission must be calculated at the rate of 5%, it is said by the company. Here 5% of the commission, 5% which will be calculated on what? 5% will be calculated on the underwriting, right? So now calculate commission on uh, commission on issue of shares account, commission on issue of shares account debtor to commission is an expenditure, so it is debited, and to whom it should be credited? It should be credited to all the underwriters, right? So A's account, then to B's account, then to C's account. Okay, so how much commission is to whom? Look at here, 15,000 shares are subscribed by the underwriter A. 15,000 shares, right? It's a liability of the underwriter to subscribe 15,000 shares. This 15,000 shares of rupees 100 each means 15 lakh rupees of capital into 5%. 15 lakh into 5%. And this is same for all the other three because they are equally subscribed. They are equally subscribed the shares. So 15,000, 1 lakh, 15 lakh into 5%. 15 lakh into 5% is how much? It's 75,000, correct? 75,000, then 75,000 for B underwriter, and for C underwriter it is 75,000. Then total of all the three underwriters total commission is to be debited to the commission on issue of shares account. So 75,000 plus 75,000 plus 75,000. How much it is? 2,25,000. Right. So this is one entry where the narration can be being commission, being underwriting commission, underwriting commission due to being underwriting commission due to the underwriters, due to the underwriters at the rate of 5%. 5% on gross liability. Okay, because they have subscribed that shares. Next is the fourth entry. What is the fourth entry? We have calculated the liability due to them. It is due, not at paid, but it is to be paid, right? First one, the capital received. The capital amount of 3,90,000 received, we have passed. Then the liability of the underwriters entry we have passed. Then we have passed the commission due for the underwriters we have passed. Next entry is the amount of commission to be paid to the underwriters. To whom? How much amount is to be paid? Look at here for subscriber A, underwriter A, 75,000 commission is to be paid. Paid by whom? By the company, because there is no any other liability from underwriter A. The company has received a complete application and also the amount. So now the company is liable to pay commission to underwriter A. So A's account debit. Then B, there is a liability for the company to make the payment of commission of 75,000. But look at here, there is a liability from the underwriter also to make the payment of 500 shares. 500 shares means how much? 50,000, correct? This 50,000 shares, 50,000 amount must be paid by the underwriter. But there is excess amount of commission, more than this amount of commission. In the sense, company is liable to pay remaining amount. So there is a company's liability, A's account debtor and B's account debtor. A's account debtor how much? 75,000. Whereas B's account is 75,000 is a liability of underwriting commission, whereas 50,000 the underwriter has to pay. So remaining only 25,000 the company can pay. Okay, next, third underwriter. Sorry, not this one. Okay. Right. Third underwriter, that is C. The liability of C is 75,000. Liability of C is 75,000, whereas the underwriter C has to pay how much? 5,50,000. Then there is a excess liability from the underwriters to make the payment to the company. So there is no liability from the company side to make the payment of amount of commission, right? So the underwriter only has to pay back to the company. So the company need not pay here. We can pass separate entry for that. Wait for a minute, 1 second. Okay, so now this amount of A's commission and remaining amount of B's commission must be paid by the company. So for this, the entry like A's account debtor, B's account debtor, it will be paid through either cash or bank, but usually it will be to bank account only. it is credited to bank account because cash or bank is going out of the company. So the total amount of 1 lakh rupees is paid by the company to the underwriter B, A and B. So let us write the narration for this being the amount paid, being amount of commission, amount, not only the commission, the remaining amount paid to A and B on full settlement. You can say it as full settlement. The full amount has been settled to A and B. We can pass the last entry for, of C's account where C is liable to pay. That means amount must be received from C. So bank account debit or debtor to C's account. To C's account. How much the C has to pay? C had to pay 5,50,000, whereas the company side they have to receive 75,000 rupees of commission. So 5,50,000 minus 75,000 is 4,75,000 is the liability of the underwriter C to make the payment to the company on full settlement. 4,75,000. You can write the narration for this as being amount paid by, not to C, it is amount paid by C to the company on full settlement. On full settlement. So like this, you have to pass the journal entries if it is asked in the problem. If the journal entry is not asked, then you need not pass any journal entries, but only the calculation of liability part. That is, the calculation of net liability of the underwriters can be passed here. Okay. So this is about the calculation of liability and the journal entry. Now I'm going to wind up the session, but today I'll be taking again the class in the evening at 6 o'clock. We'll complete the portion of this unit. Okay, we'll do some more problems for this underwriting portion of unit, and we'll finish it off today. I'm going to handle class at 6 o'clock also. Kindly join for the link which will be sent later. Okay, I will send you the link relating to the class at 6 o'clock. Thank you.